Hello everyone, Steve Lynch here with Discover Options. Welcome to this edition of the Market Reports. This is for Friday ending January 20th, getting ready for the open on Monday on the 23rd. We have two reports for you today. The S&P 500 Condor Butterfly Timing Report for those of you that sell premium in a market neutral fashion. Then also for those more statistically oriented, we have the Directional Likelihood Report. Presented material today is for educational purposes only and should not be construed as personalized financial advice. The current market condition looks like this. We had an outside day on Thursday, and then Friday the market went up above Thursday's high in an upswing day with a higher high and a higher low. We're above the 50-day moving average in a trend that is in the long term upward. And then from the stochastic perspective, we're between 50 and 99, and we are underneath our 3-day moving average there slightly. So a very unique market condition when you take the price action, the trend, and the stochastic profile. That situation has only occurred roughly 28-30 times or so since January of 2000. So not that often. But we're going to look at this current condition and run the numbers and see how well it measures up for both of those reports. Real quick though, if you want a free ebook, you can click on the link and give us your information. We'll get this ebook out to you, Simple Steps to Options Trading Success. And also if you want to subscribe, we'd appreciate that. That way you can get alerted whenever we come out with a new broadcast. Let's take a look at the Condor and Butterfly Timing Report for Friday ending January 20th. We are going to get into the weeds as to the methodology here, but for those of you that are veterans of this, let's just get right to the numbers, and then we'll cover both reports and the numbers for both of those. So here we can see we have a positive edge for selling premium neutrally of 13.6. The number of signals is 28. So let's just go through this narrative that you see there in the middle of the screen. Since January of 2000, there have been over 4,200 daily closes of the SPX. Of those, 64.9%, about 65%, have been favorable bars for selling premium where the actual 21-bar movement was less than the SIBO SKEW adjusted implied movement. Okay, about 65%. Also during that time, the current condition, the one I just showed you, has occurred 28 times. Of those occurrences, of those 28, 78.5 of those, 78.5% of the bars have been similarly favorable for options premium selling. Now that implies that an edge of roughly 13.6% for selling premium neutrally. So statistically, it's more likely than usual that Friday's bar will end up being favorable for market neutral option premium selling. So that's the Condor Butterfly Timing Report. We don't have enough to make it, I wish we had more than 28 occurrences. It'd be more statistically significant if there were, pushing up to 100, but the current condition we have is fairly rare. So we're going to just report those 28 and the statistics behind those anyway, and you can judge for yourself if 28 is statistically significant enough. I prefer it to be much higher, double that to start getting more statistically significant, even 4 times that, go into 100. But it is what it is, and we're going to report that to you anyway. All right, now let's go to the market likelihood report using the same number of occurrences, which you'll see here. Now we'll get into the weeds in a little bit, but for those of you that are veterans of this, just note that we have a lot of red numbers here indicating lower market volatility. That kind of goes hand in hand with the statistical edge that we just saw for premium sellers. Lots of red numbers implying that that there's a likelihood of lower market volatility ahead. All right, that's just the likelihood, and so we're using 3 sets of bands. 3 to the upside, 3 to the downside, and after this market condition, those bands are getting struck typically less often. Except in the case if price goes above Friday's high. Then we have some blue numbers there on the upside, just slightly. But all in all, you're looking at a picture of lower market volatility. Also with the SKEW adjusted VIX bands, lots more red numbers than blue. So a picture of lower market volatility that you see here. All right, now let's get into the methodology behind these. First, the Condor and Butterfly timing report. We'll look at the methodology and why you should study this, as well as the current condition and edge level in the details. Here's an example from late 2015 when the market began to channel, and typical option premium sellers might have gone ahead and taken a dive and had sold premium outside the support and resistance levels here. But when you run the numbers using our methodology, we found that there was indeed at the time a negative edge, meaning at the time that there was a higher than usual likelihood that the market was going to be more volatile than what was implied by the option prices. And sure enough, in that particular case, the market took a dive to the downside. So it's not necessarily statistically predictive of more volatility. All we're saying is that the statistics are showing that there's a greater likelihood of it being more volatile than normal. Now, our current market condition is just like what I showed you. We had an outside day on Thursday. Friday, it went above Thursday's high. And so there we sit. Here's the question on the table. Is this condition a good one for selling premium through range trading, butters and condors? And that's the question we're going to answer. We're going to do that by looking at historically the actual volatility from a given close. We're going to look at the implied volatility of the option prices. Then we compare the two. We're going to compare the two. How much did the market move compared to what was being implied? And then we're going to label bars either favorable or unfavorable in that regard. So for example, we have the actual volatility from a given close. We take a given close, look forward 21 bars, and ask ourselves, how far did the market move at the most, either up or down? All right, in this case, it moved 50 points, which turns out to have been about 2.4% of that index value. Now, the question on the table is, at that time, what market move was being implied by the option prices? We know it moved 2.4%, but what we find is that the SKEW-adjusted VIX showed that the market was predicted to have a 4.4% move based upon the prices of the options. Okay, so the market moved less than what the options were implying, meaning that those bars then were favorable for selling premium because the market moved less than what was being implied. We would normally paint all those bars blue which had that relationship. And that's what we do here. We paint the bars blue that turned out to have been favorable. We paint the bars red that turned out to have been unfavorable. And for the last 21 bars from today moving back, we don't know what those are. Those are still black. It's unknown. We have to wait 21 bars, a full 21 bars, before we can judge them to have been favorable or unfavorable. Now what we're going to do is go back in time and look at what percentage of all the bars are favorable, and that's our benchmark. Then we look at the bars that match our current market condition, all 28, 29 of them. And we ask ourselves what percentage of those were favorable for premium selling. And if there's a big difference between the baseline and the current condition bars, well, there might be an edge. So when you go back and look at all, almost 4,300 bars in the SPX, going back to Jan of 2000, we find that almost 65%, 64.9% of those bars were favorable for premium selling. Okay, now we're going to look at those 28 or 29 that match our current market condition and ask ourselves what percentage of those were favorable. When we do that, we find that 78.5% turned out to have been favorable for premium selling. Of those 28, 78.5% turned out to have been favorable for selling premium. And this turns out to an edge of about 13.6% positive edge. Again, I'm bothered by the 28 being kind of a low number. I wish it were 2 to 4 times higher than that. But again, we're going to just report to you the way it is and let you take that information and run with it. 13.6% edge. That means that there is a higher than usual likelihood that the market will be less volatile than what is implied by the option prices. So that is the Condor Butterfly Timing Report. Before we move on to the more statistically based market likelihood report, make sure you understand we have a great curriculum here at Discover Options, whether you trade equity, options, ETFs, stocks, indices, or if you are in futures, we have a curriculum for you with a great team of mentors ready to work with you one-on-one, getting you up to speed and helping you go from an beginning intermediate level to advanced, all the way up to a money manager if you want. We'll take you all the way as far as you want to go in as quick a time as possible with the mentoring team we have and the curriculum we've developed and the tools we have. It's top-notch. In our estimation, we occupy the highest level of professionalism in this options education industry, particularly with regards to one-on-one tutoring to get you to where you want to go. All right, give us a call. Take a look at our curriculum online. We'd love to have you join our family here. All right, the market likelihood report. We're going to get into the weeds here as to what all these numbers mean. Let's take a look at the current condition, and here's the question on the table. Since Jan of 2000, how often has this same market condition occurred? We know around 28, 29. What did the market do in terms of direction and volatility for those 28, 29 times? All right, here's how we go about this. All right, for us to determine what happened in the past, we need to address this from the standpoint of price distribution. Okay, we're going to look at the historical distribution of price from a baseline standpoint, from every close over the last 4,200, 4,300 closes. What's the general distribution? Then we're going to look at the distribution of price after our market condition developed in the past. And if there's a big difference, well, then we might have an edge. So let's go take a look here. Historical distribution. How do we determine this? We use 3 sets of volatility bands set from each day's close. Okay, 5, 10, and 15 days out. Both set above the close and below the close. We use a 20-day historical volatility number to determine the width of those bands, and these are normally distributed. Let's just take an example here. Here's a set of 10-day bands. We're looking at the close here. These are set 1 standard deviation out for 10 days. And here is the question. After this close, did price go up and hit the upper band, the lower band, or wobble in the middle and not hit either of them? And in this particular case, price did go up, and actually in one day it hit that upper band. So for that particular close, we note that it hit the upper band. Now for this one, we have the upper band, the lower band, and the question on the table is, did price hit either of these bands? And in this case, it ended up not. It tried to come down and hit that lower band, close but no cigar. So in that particular case, it hit neither band. So what we do then is for each close, we record how, counting every close, we look at how often price struck the upper and lower 5, 10, and 15-day bands. All right, and we just have a benchmark. And here's what it looks like. Oh, and I messed up the copy and paste here. This should be 20. This is Jan of 2000 through January 20th of 2017. Over the course of 4,269 occurrences, there's been that many price bars since Jan of 2000. Price has struck the upper 5-day band 29.2% of the time, the upper 10-day band 23%, 15 band 23%, the lower on the downside, the lower 5-day band 29.5%, the lower 10-day band 29.3%, lower 15 32.1%. So this is the baseline price distribution in the SPX since January of 2000, okay? Now, what do we do now? Now we're going to look at this distribution after a specific market condition develops, our market condition that I just showed you. And we're going to look at the way price was distributed as of the close. We're going to look at the way price was distributed if it went up above the previous day's high. So Monday, if price goes above Friday's high, we're going to know historically what the distribution has been in that case. What if price goes below Friday's low on Monday? On Monday, if it goes below Friday's low, we're going to have an idea of the distribution in that situation. So I think it's very worthwhile for serious traders to kind of have this level of understanding. Here's what happens out of those 29 occurrences. Okay, going back, price struck the upper 5-day band 13.8% of the time. That's a lot less than the benchmark 29.2. That's why we have a pretty strong red number there. Of those 29 occurrences, price struck the upper 10-day band only 10% of the time. Struck the upper 15-day band 17.2% of the time. A lot less than the benchmark here. On the lower end, on the lower price struck the lower 5-day band 24% of the time, a bit less often. The lower 10-day band 13.8, a lot lower. And the lower 15-day band 24.1% of the time, again lower. So all across the board, we're seeing a picture of lower market volatility just simply as of Friday's close. Now, let's take a look at those other incidences. If price goes above Friday's high, we can see that the upper bands get struck a little more often. The lower bands get struck less often, although, look at that, I mean, it looks like, indeed, the lower 15-day band did get struck about the same over there. Now, that's only 12 occurrences, so we're going to, be that as it may, we're going to report the numbers. If price goes below Friday's low, we see all across the board 6 incidences of lower incidences where price, price failed to strike those bands less often than the benchmark all across the board here. Again, a picture of lower market volatility in terms of likelihood. Let's look at now what happens when we use a skew adjusted VIX figure to determine the width of those bands. VIX is generally higher than statistical volatility, and so the bands get struck less often as a benchmark up here. All right, but even then you'll see more red numbers certainly than blue pretty much across the board here. Here are the volatility numbers. We like to do skew adjusted upside and downside VIX numbers. So there's an upside VIX and a downside VIX. Keep this downside VIX in mind. Here's just a trading idea. If you're bullish at all going into this, what I did is I didn't do a broken wing. We did a hedged bull put spread. I'm sorry, let me just switch that. I'm going to do that on the fly right now. Hedged bull put spread. There you go. Hedged bull put spread. We plugged in 14.2 up here because that is the skew adjusted VIX. That sets our standard deviation here, going out about 30 days, a little more than 30 days in this case. We do a bull put spread a standard deviation away. We take some of this credit and purchase an at-the-money bear put spread. Okay, that's more than paid for. We still have a net credit coming in. And when we analyze that, here we go, timeout, boom, there we go. We get a real nice high probability of profit. We're way outside the standard deviation here. We're in the low to mid 80s in terms of probability of profit. But more importantly, no matter how far the market goes up, we're going to make some money. If the market comes down, we can see that hedge starts kicking in, lifting that shoulder, and it's a real nice shape to our risk curve. Here's what the profit zone looks like. The market's going to have to take a dive fairly quick for us to lose money on this. Altogether, a pretty strong looking chart here. Thanks for joining us, folks. Hope this has been helpful. Here we go, click there. There we go, boom. There we go. We'll be back next week at the weekend sometime. Same bad time, same bad channel. Take care. Have a great rest of the week trading. Bye-bye.